bring in EY Chairman and CEO Mark Weinberger, along with Canyon Partners founding partner and co-chief executive officer Josh Friedman. Good to see you both, gentlemen. Thank you so much for joining us. Let's talk global markets and the global economy. First off, Josh, talk to us about what's going on in these markets. To what do you attribute this meltdown, in particular on the high-yield side?
I think the high-yield side is very different from the equity markets, although sentiment plays a key factor in tying the two together. If you look over the last 5 years since, say, 2007, the high-yield market has doubled in size. The growth of debt globally on corporate balance sheets and on sovereign balance sheets has vastly exceeded GNP growth. So it was probably time for a correction. We went through a period where there was such a compression of yields and such monetary stimulus that the difference between, say, a CCC bond and a BB bond was almost non-existent. It was maybe 250 basis points. So it was time, when people were taking a lot of risk and going down the credit spectrum, for that to normalize. There are some triggers, things like the oil prices clearly, but that spread, for example, between CCCs and BBs now is over 1,000 basis points. We haven't seen that in years and years.
It's really a market that a lot of people haven't ever seen, by the way, when you look at the makeup of people who are on the trading desks and investing. But, Mark, I wonder if this is warranted to the extent that we're seeing this sell-off. I mean, $2 trillion in market value loss in equities alone is pretty severe. You're all around the world talking to executives and CEOs. How do you characterize the demand story, the global economy?
Yeah, I'm happy you're asking Josh the market questions, because I don't know if it was too high earlier or it's too low today. But if you look at the global economy, I don't see from the CEOs we talked to from our own business in 152 countries anything near what we had in 2008 to suggest this massive sell-off, other than valuation issues that may have been in the marketplace. We are seeing incredible headwinds and the vast number of uncertainties out there, whether it be geopolitical, whether it be economic, whether it be, and what I worry about, Maria, when I talk to CEOs, when you look at the numbers, the Business Roundtable, we've talked before I'm on, in the U.S., and this is around the world, CapEx expenditures is going down every single quarter. So there's no investment for the future. So where's the productivity going to come from in the future? That could hit valuations and could cause an adjustment in the market longer term. There's just no investment right now because of this uncertainty.
This is a really important point, because we actually had Jamie Dimon on, CEO of JP Morgan, on last week, and I asked him the question, when you see the kind of lending that you're talking about, is that lending going to corporations because they want to use that money to invest in their businesses, or is it for M&A? And, the question is an important one, because if it's not for CapEx, that's really what is mirroring what's going on.
Yeah, I would say it's an excellent question. When they're looking for growth today, companies are often merging to go out and buy it, acquire it, as opposed to build it. And when you look at the short-term thinking, a lot of in Davos we're going to be talking about long-term versus short-term thinking. The pressure is for stock buybacks and dividends. If you look at the ratio of those to CapEx investing over the last year, it doesn't portend well for longer-term productivity growth.
That's not good. I mean, you really want to see companies investing in their business. So, Josh, you're right in these markets. I mean, you're looking long-term as well on an investor basis, but you've got $21 billion in assets under management. What do you do when you wake up in the morning and you see a market like this?
First thing you do is take a deep breath and show some patience, because it's not over yet. It's not over yet. Second thing you do is you take a look at the structure of the market to figure out where the most dramatic dislocations are likely to take place. One of the characteristics of this market compared to earlier markets is an incredible lack of liquidity, but also a huge buildup of assets, i.e. loans and high-yield bonds, in the hands of funds that actually give their investors daily liquidity. And that's a toxic combination. You have no capital by investment banks or commercial banks being used for market making, and yet you have literally 4 times as many bonds and loans being held by overnight liquidity funds. So when someone has to sell and there's no market maker and capital is moving in the other direction, prices can drop quite a lot further than rationally they should.
Well, when you want to sell, you sell what you're able to sell.
Exactly.
Right? You sell what you can sell. So if you don't have the liquidity in one market, well, then I'm going to go to the liquidity in XYZ stock, because I got to get out.
You also see big disparities in bonds that are similar credit quality, because some bonds are part of larger issues and they're very liquid. So this will adjust, which is why you have to take a breath and take your time. And then when you want to buy something, don't be afraid to put out a very low bid.
This issue that Josh brings up, liquidity, Mark, this was brought up by a number of the bank CEOs back in the day, about a year ago, when they were complaining about overregulation. Basically saying, if you force us to hold all this capital up here, we're not going to be in a position to provide liquidity when the market actually needs it. I think this day is when the market actually needs it.
Well, you're absolutely right. I mean, if you've talked to Jamie, he was probably very eloquent on this. He's talked a lot about it, how some of the ways we got through the 2008 problems when the banks came forward and lent money to a lot of these, especially small and medium-sized enterprises, and they're just not capable to do it today and meet the new requirements on holding requirements
So the
for equities.
regulatory environment's still an issue for the CEOs that you're speaking to?
Yeah, the regulatory environment's still an issue across the board, whether it be technology and privacy, and whether it be regulations on banking and financial markets, whether it be, regulations on investment, you name it. That uncertainty adds to the uncertainty tax that we often talk about.
Real quick, Josh, on opportunities, do you see any on the horizon right now?
Yeah, I think there are a lot of what I would call decent quality high yield bonds that are trading over 10% for the first time in years. I mean, literally, we've got $300 billion of the market trading at a 10% spread to treasuries, which is extraordinary. We haven't seen that since '08. And even in '11, nowhere near this amount.
Yeah.
But I do think caution's warranted. I think you have to be careful. I think we're going to see a whole other wave of distress. We've seen it in oil and gas, but even in oil and gas, the securities prices are not probably as low as would be warranted by $28 oil.
All right, we will leave it there. Josh